Welcome to Golden Years Finance. CNAs, claim you're missing $400 per month Social Security benefit. Most skip this box. Take a look at your last Social Security deposit. Now imagine finding out that your monthly payment could be hundreds of dollars higher, not because Congress approved a benefit increase, not because you qualify for a new government program, and not because Social Security made a mistake. The money may already belong to you. It's simply being held somewhere else. Every year, thousands of retirees discover they've been unnecessarily giving up part of their Social Security income because of a decision they made when they first applied for benefits. It wasn't a complicated investment choice. It wasn't a retirement planning strategy. It was a small selection on a government form that most people complete once and never think about again. For some retirees, that forgotten election is costing $200 a month. For others, it's $300. And in many cases, the amount exceeds $400 every month. What's remarkable is that the problem often continues for years without being noticed. The checks keep arriving. The deposits look normal. And because nobody from Social Security calls to say anything is wrong, retirees naturally assume everything is working exactly as it should. But that's not always the case. Today we're going to uncover one of the most overlooked reasons retirees lose money from their Social Security benefits. We'll explain why the issue happens, how to determine whether you're affected, and what steps may be available to correct it. And if you're like most retirees, the answer may be hiding in paperwork you haven't looked at in years. Let's start with a simple question. Who decides how much federal tax is withheld from your Social Security benefit? If you answered Social Security, you're not alone. In fact, many retirees believe the government automatically calculates the correct amount based on their income, just like employers handle payroll withholding during their working years. That's a reasonable assumption. It's also wrong. The Social Security Administration does not analyze your tax return every year and adjust withholding accordingly. Instead, the agency follows instructions that you provided. Often those instructions came from a document called Form W-4V, a voluntary withholding request. The key word is voluntary. You choose whether taxes are withheld. You choose a percentage. And unless you update that election, the same withholding instruction can remain in place for years or even decades. That's where many retirees run into trouble. Think about how much your financial life may have changed since you first claimed Social Security. Perhaps you retired completely. Maybe your pension income changed. Perhaps you stopped taking large IRA withdrawals. Maybe your investment income declined. Or perhaps your tax deductions increased. Any one of those changes can affect how much tax you actually owe. Yet your withholding election may still be operating as if none of those changes ever happened. The result? Money continues leaving your Social Security check every month even though your current tax liability may be far lower than it once was. Here's an example. Suppose a retiree receives $2,200 each month in Social Security benefits and elected 10% federal withholding years ago. That means approximately $220 is withheld every month. Over 12 months, that's $2,640 sent to the federal government before a tax return is even filed. Now imagine that retirees' actual tax obligation turns out to be only $800 for the year. The difference, $1,840, eventually comes back as a refund. But here's the important point. A tax refund isn't extra money. It's your own money being returned after spending months outside your bank account. For retirees living on fixed incomes, having access to that money throughout the year can make a meaningful difference. Of course, overwithholding isn't the only problem. Some retirees face the exact opposite situation. Because they elected no withholding at all, they assume no taxes are due. Unfortunately, Social Security benefits can become taxable depending on your overall income. And that's where another important concept comes into play: provisional income. Most retirees have heard the term before, but few understand how powerful it is. Provisional income is a calculation the IRS uses to determine whether any portion of your Social Security benefits is subject to federal taxation. The formula combines income from other sources, tax-exempt interest, and half of your annual Social Security benefits. Once that number is calculated, specific thresholds determine how much of your benefit may be taxable. For single filers, the first threshold begins at $25,000. For married couples filing jointly, it begins at $32,000. cross those thresholds and a portion of your benefits may become taxable. Move higher, and as much as 85% of your Social Security benefits may be included in taxable income calculations. The surprising part is how easily retirees can cross these lines. A pension, a few IRA withdrawals, dividend income, part-time work, interest earnings. Individually, these sources may seem modest. Together, they can significantly increase provisional income. That's why many retirees discover their taxes despite believing their Social Security benefits were tax-free. At the same time, many others discover the opposite, that they have been withholding taxes for years when their provisional income falls below taxable thresholds altogether. And that brings us back to the missing money. The amount you're losing isn't always a result of higher taxes. Sometimes it's simply a mismatch between your current financial reality and instructions that were created years ago. But taxes aren't the only deduction retirees should review. Another major area involves Medicare premiums. Many retirees don't realize that Medicare often determines premium costs using income information from 2 years earlier. That means someone who recently retired may still be paying premiums based on earnings from their working years. If income drops substantially after retirement, those higher premiums may no longer reflect reality. Fortunately, the government provides a process for requesting a review. Through Form SSA 44, eligible retirees who experience certain life-changing events, including retirement, may request a recalculation based on current income levels. For some households, that adjustment can translate into significant annual savings. Yet many never apply because they simply don't know the option exists. And that's really the lesson behind everything we've discussed today. Government systems generally continue operating based on the information they already have. They don't automatically optimize your retirement income. They don't automatically lower withholding because your taxes changed. They don't automatically reduce Medicaid premiums because your income dropped. And they don't automatically identify opportunities that could put more money back into your pocket. That's why periodic reviews matter. Sometimes the difference between receiving the correct amount and losing hundreds of dollars every month comes down to a single election, a single calculation, or a single form that hasn't been updated in years. If you've never reviewed your Social Security withholding, calculated your provisional income, or evaluated whether your Medicaid premiums still reflect your current earnings, now may be the perfect time. Because the money isn't always gone. In many cases, it's simply waiting for you to claim it.